What does it take to stop a panic once trust has already left the room? When does a single voice carry enough weight to steady an entire system built on belief? How much time do you really have when money itself starts to vanish into fear? Tonight we drift back to the autumn of 1907, to a moment when the financial architecture of America trembled, when banks locked their doors and crowds gathered in silence, and when one aging banker became the last line between order and collapse. Take a slow breath. Let the story unfold at its own pace. If you'd like more calm market history, you can subscribe. This is history, not financial advice. The year 1907 arrived with confidence. American cities hummed with electric streetcars and steel construction. Railroads stretched farther west each season. Factories multiplied along rivers and coastlines. The stock market had climbed steadily for years, and credit flowed freely through a network of national banks, state banks, and trust companies. Trust companies in particular had grown popular. They operated with fewer regulations than traditional banks, paid higher interest on deposits, and offered a sense of modernity. They invested in real estate, in stocks, in bonds. They promised returns that felt generous, and people believed them. But beneath the surface, the system carried fragilities that few paused to examine. There was no central bank in America in 1907. The Federal Reserve would not exist for another 6 years. When liquidity dried up, there was no lender of last resort, no institution designed to inject cash into a seizing market. Instead, the banking system relied on a patchwork of clearinghouses, correspondent relationships, and the personal reputations of a few powerful men. If trust faltered, the structure could fold quickly. J.P. Morgan was 70 years old that autumn. His nose was famously disfigured by a skin condition, his gaze stern, his presence intimidating. He had spent decades consolidating industries, financing railroads, underwriting government bonds, and reshaping corporate America. He was not universally loved. Many saw him as a symbol of monopoly and concentrated power. But he was also recognized as the most influential private banker in the country, a man whose word could move markets and whose judgment carried weight in moments of uncertainty. Morgan had weathered financial storms before. In 1895, he had helped stabilize the U.S. gold reserve during a currency crisis, working directly with President Grover Cleveland. In 1903, he orchestrated the formation of U.S. Steel, the first billion-dollar corporation. He understood the mechanics of confidence, the way money moved not just through ledgers but through networks of trust and reputation. He knew that in a panic, facts mattered less than perception, and that speed could be the difference between recovery and ruin. The trouble began quietly in October. A pair of speculators, Augustus Heinze and Charles Morse, had been attempting to corner the stock of United Copper Company. Their plan was straightforward in theory: buy up as much stock as possible, force short sellers to cover their positions at inflated prices, and profit from the squeeze. But the scheme failed. The price of United Copper collapsed instead of soaring. Heinze and Morse faced massive losses, and the banks and trust companies they controlled suddenly looked fragile. Heinze had ties to several banks in New York. When news of the failed corner spread, depositors began to worry. If Heinze's banks were exposed to his speculation, were their deposits safe? Rumors moved faster than facts. By mid-October, lines began forming outside certain institutions. People wanted their money back, not because they had proof of insolvency, but because they feared others might withdraw first. This is the core mechanism of a bank run, not evidence of failure, but the fear that belief itself is evaporating. The first bank to face serious trouble was the Mercantile National Bank, where Heinze served as president. Depositors arrived early in the morning, standing quietly on the sidewalk, waiting for the doors to open. Inside, tellers counted cash and tried to maintain calm. The bank's clearinghouse associates pressured Heinze to resign. He did, but the damage had been done. Confidence, once shaken, does not return simply because a name changes on the letterhead. Meanwhile, Charles Morse's network of banks came under similar scrutiny. He too was forced to step aside from his positions, but the contagion did not stop with the men who had sparked it. Trust companies, which held large deposits and had invested aggressively, became the next targets of suspicion. On October 21st, the Knickerbocker Trust Company, one of the largest and most respected institutions in New York, found itself at the center of growing anxiety. The Knickerbocker's president, Charles Barney, had some association with Morse, though the extent of his involvement in the copper speculation was unclear. It may not have mattered. Perception was enough. Depositors began lining up outside the Knickerbocker's offices. The line stretched down the block. People stood for hours, patient but determined. Some brought chairs. Others sent family members to hold their place. The bank paid out withdrawals throughout the day, but the reserves dwindled with each transaction. By the evening of October 21st, the Knickerbocker Trust Company had suspended payments. The doors closed with depositors still waiting outside. The suspension sent a ripple of panic through the city. If the Knickerbocker could fall, which institution was truly safe? Trust, once a vague and comfortable assumption, had become a scarce and measurable resource. That night, the financial district felt different. The usual evening quiet carried a tension. Messengers moved between offices. Telegrams were sent to correspondents in other cities. Bankers met in private dining rooms and club lounges, trying to assess the scope of the crisis. The question was not whether the panic would spread, but how far and how fast. The next morning, October 22nd, the panic widened. Other trust companies faced withdrawals. The Trust Company of America, a major institution with branches across the city, saw crowds gather at its doors before opening. The president of the trust company, Oakley Thorne, understood what was at stake. His institution was solvent on paper, but solvency meant little if depositors wanted cash faster than assets could be liquidized. A bank run is not about balance sheets. It is about time and belief. Thorne needed help. He reached out to other bankers, to clearinghouse officials, to anyone who might provide short-term liquidity. But the usual channels of assistance were constrained. Banks were hoarding cash to protect their own reserves. The stock market was falling, making it harder to sell securities at reasonable prices. The commercial paper market, where businesses borrowed short-term funds, had tightened. Money, in the practical sense, was vanishing from circulation, even though it still existed somewhere in the system. In moments like this, liquidity is not about the total amount of money in the economy. It is about whether money can move quickly enough to where it is needed. A system can be collectively solvent but individually illiquid, and that gap can destroy institutions that might otherwise survive. The panic of 1907 was, in many ways, a liquidity crisis more than a solvency crisis. But the two are difficult to separate in real time. J.P. Morgan was not initially involved in the Knickerbocker situation. He had been in Richmond, Virginia, attending an Episcopal convention when the trouble began. He returned to New York on the evening of October 21st, arriving to find the financial district already gripped by fear. Morgan was not a man who sought the spotlight in moments like this, but he understood that leadership, in a crisis, is often about presence and decisiveness rather than formal authority. On the morning of October 22nd, Morgan convened a meeting at his library on East 36th Street. The library, a palazzo-style building filled with rare manuscripts and Renaissance art, served as both his personal sanctuary and his informal headquarters. Bankers arrived throughout the day. Some represented major national banks. Others led trust companies. A few were clearinghouse officials. They gathered in Morgan's study, surrounded by books and paintings, and tried to determine which institutions could be saved and which could not. The discussions were blunt. Morgan asked direct questions about reserves, about asset quality, about the speed of withdrawals. He listened more than he spoke, but his presence shaped the tone. There was no government authority to turn to, No regulatory body with the power to inject capital or guarantee deposits. The solution, if one existed, would have to come from private coordination. The Trust Company of America became the immediate focus. Thorne provided detailed information about the institution's holdings. Morgan and his associates examined the books. The conclusion was that the trust company was fundamentally sound, but it needed liquidity quickly. If it could survive the next few days, confidence might stabilize. If it failed, the panic would almost certainly spread to other institutions, including commercial banks. Morgan made a decision. He would organize a consortium of banks to provide short-term loans to the Trust Company of America. The loans would be secured by the trust company's assets, but the risk was real. If the panic continued, even good collateral might lose value. Still, the alternative was worse. Allowing the Trust Company of America to collapse would likely trigger a cascade of failures across the city. That afternoon, cash began flowing to the trust company. Armored wagons delivered currency from the clearinghouse and from participating banks. Tellers stacked bills on counters, making sure depositors could see the reserves. The line of withdrawals continued, but the pace slowed slightly. Some people, seeing that the institution could still pay, chose to leave their money in place. Others withdrew everything and carried it home in bags and coat pockets. Meanwhile, the stock market was deteriorating. The New York Stock Exchange, located on Broad Street, had become a place of desperation. Stock prices were falling sharply, not because companies were suddenly worth less, but because brokers needed to sell anything liquid to meet margin calls and client redemptions. Trading volume was heavy, but liquidity was thin. Bid-ask spreads widened. Some securities could barely be sold at any price. By mid-afternoon on October 22nd, word spread through the exchange that several brokerage houses were on the verge of failure. Brokers needed loans to settle their trades, but banks were reluctant to lend. The usual sources of call money, the overnight loans that kept the exchange functioning, had dried up. Without those loans, trading could not continue. The president of the stock exchange, Ransom Thomas, realized that the market itself might have to close early. Closing the stock exchange would be a drastic step. It had remained open even during previous panics. Shutting the doors would send a signal of systemic failure, potentially worsening the crisis. But keeping it open without adequate liquidity could lead to broker insolvencies and a complete breakdown of orderly trading. Thomas sent a messenger to Morgan's library. Morgan was still in meetings when the message arrived. He read it quickly, then turned to the bankers in the room. The situation was clear. The stock exchange needed roughly $25 million in short-term loans to keep brokers solvent until the closing bell. Without it, the market would have to suspend trading. Morgan polled the room. Could the assembled banks provide the necessary funds? The response was cautious. Banks were already stretched. Providing loans to brokers meant reducing reserves available for depositors, but the alternative was a market closure that might trigger even greater panic. Morgan pressed the point. He argued that the interconnectedness of the system meant that failure at the stock exchange would ripple back to the banks. Confidence was indivisible. If the market closed in chaos, depositors would assume the worst. Within the hour, commitments were made. The assembled bankers agreed to pool resources and extend credit to the brokerage houses. Messengers ran back to the stock exchange with the news. The loans arrived just in time. Trading continued until the normal closing bell at 3 o'clock. The market had survived the day, though prices had fallen significantly. That evening, exhaustion settled over the financial district. The crisis had not ended. Trust companies continued to face withdrawals. Banks hoarded reserves. The commercial paper market remained frozen. But the immediate catastrophe had been postponed. The Trust Company of America had stayed open. The stock exchange had completed its session. Small victories, but they mattered. Morgan returned to his library. He was 70 years old, and the strain was visible. but he understood that the next days would require sustained coordination. There was no script for this, no regulatory playbook. The Federal Reserve Act, which would later create mechanisms for exactly this type of crisis, was still 6 years away. In 1907, the system relied on improvisation and the willingness of private actors to absorb collective risk. Over the following days, the pattern repeated. Each morning brought new threats. Institutions that had seemed stable days earlier now faced withdrawals. The panic spread beyond New York. Banks in other cities began restricting payments. Some suspended cash withdrawals entirely, paying depositors in cashier's checks or certificates instead. This restriction of cash, while intended to preserve reserves, further eroded confidence. People wanted currency, not promises. Morgan's library became the de facto command center. Meetings ran late into the night. Bankers, trust company presidents, clearinghouse officials, and even city officials cycled through. The discussions focused on triage. Which institutions were genuinely insolvent and should be allowed to fail? Which were illiquid but fundamentally sound and deserved support? The line between the two was not always clear. One institution that drew particular scrutiny was the Lincoln Trust Company. It faced severe withdrawals and had limited liquid assets. Morgan and his team reviewed the books. Assessment was grim. The Lincoln Trust had made speculative loans and held assets that were difficult to value in a falling market. Supporting it would require significant capital with uncertain prospects for repayment. After long deliberation, the decision was made to let the Lincoln Trust fail. Resources were finite, and they had to be directed toward institutions with better chances of survival. The failure of the Lincoln Trust sent another shockwave through the city, but it also clarified the boundaries. Not every institution would be saved. The message, though harsh, introduced a form of discipline. Depositors and creditors understood that risk was real, that failures would happen, but also that the strongest institutions were receiving coordinated support. This distinction mattered. Panic thrives on uncertainty. Clear decisions, even painful ones, can sometimes restore a measure of predictability. Meanwhile, the city of New York itself faced a liquidity problem. The city government needed to issue short-term bonds to meet payroll and operational expenses. Normally, these bonds would be purchased easily by banks and investors. But in October 1907, there were no normal buyers. Banks had no spare capital. Investors were fleeing risk. If the city could not sell its bonds, it might default on obligations, including payments to municipal workers and suppliers. The prospect of a city government default added another layer of anxiety. Morgan took on this problem as well. He organized a syndicate to purchase the city's bonds, providing the municipal government with the cash it needed. The terms were strict and the interest rates were high, but the city avoided default. This intervention was less visible than the bank rescues, but it was no less important. A city government failure would have deepened the sense of systemic breakdown. By late October, the immediate panic at the trust companies had begun to ease. The Trust Company of America, propped up by emergency loans, was still operating. Depositors continued to withdraw funds, but at a slower pace. Some people, reassured by the coordinated response, even began redepositing money. Confidence, though fragile, showed signs of stabilizing. But the crisis was not over. A new threat emerged from an unexpected direction. The city's brokerage houses, which had narrowly survived the previous week, faced another liquidity crunch. The stock market remained weak, and margin calls continued. More importantly, many brokerage firms held large positions in the securities of a company called Tennessee Coal, Iron and Railroad, known as TC&I. TC&I was a southern steel and coal producer, smaller than U.S. Steel but substantial. Its stock had been used as collateral for loans by several brokerage houses. As the stock price fell during the panic, the value of that collateral declined. Brokers faced margin calls they could not meet. If they were forced to liquidate their TC&I holdings in a falling market, the price would collapse further, triggering more margin calls and potentially bankrupting the firms. A group of brokers approached Morgan with the problem. They needed a buyer for the TC&I stock, someone who could purchase it at a price high enough to prevent broker insolvencies. But who would buy a large block of stock in a distressed market? The obvious answer was U.S. Steel, the industrial giant that Morgan had helped create. U.S. Steel could absorb TC&I, gaining its assets and removing the stock from the distressed brokerage houses. But this solution raised complications. U.S. Steel was already enormous, controlling a dominant share of American steel production. Acquiring TC&I might trigger antitrust scrutiny. The Roosevelt administration had taken an aggressive stance toward corporate consolidation, and the president, Theodore Roosevelt, had personally targeted monopolistic practices. Would the government allow such a merger in the middle of a financial crisis? Morgan dispatched 2 U.S. Steel executives, Elbert Gary and Henry Frick, to Washington to meet with President Roosevelt. They traveled overnight, arriving at the White House early on the morning of November 4th. Roosevelt received them in his office. Gary and Frick explained the situation. Brokerage houses were on the verge of collapse, and the failure could reignite the panic. U.S. Steel was willing to purchase TC&I, not for profit, but to stabilize the market. They asked for the president's assurance that the government would not challenge the acquisition on antitrust grounds. Roosevelt faced a difficult choice. He was philosophically opposed to corporate consolidation, but he also understood the severity of the financial crisis. The meeting was brief. Roosevelt gave his assent, stating that he would not interfere with the merger. The decision would later be criticized as a giveaway to Morgan and U.S. Steel, but in that moment it was framed as a necessary step to prevent further panic. The acquisition of Tennessee Coal and Iron by U.S. Steel was announced quickly. The brokerage houses holding TC&I stock were able to settle their positions without catastrophic losses. The immediate threat to the stock exchange receded. Once again, a potential collapse had been narrowly avoided, but the broader crisis persisted. Cash remained scarce. Banks across the country continued to restrict withdrawals. In many cities, businesses struggled to meet payroll because they could not access sufficient currency. Some employers paid workers in scrip or IOUs, temporary substitutes that circulated locally but lacked the security of legal tender. The economy was not collapsing, but it was contracting sharply. Commerce slowed. Unemployment rose. The panic's effects rippled far beyond Wall Street. Morgan understood that the ultimate solution required restoring liquidity to the banking system as a whole. Individual rescues of trust companies and brokerage firms addressed symptoms, but they did not solve the underlying problem. There was not enough currency in circulation to meet demand, and there was no institution capable of creating it. The Treasury Department had limited tools. Secretary of the Treasury, George Cortelyou, had deposited government funds into national banks to provide some relief, but the amounts were modest compared to the scale of the need. Morgan and his circle of bankers worked on a broader plan. They needed to create confidence that the banking system collectively had enough resources to meet depositor demands. One mechanism was to strengthen the clearinghouse system. Clearinghouses were cooperative associations of banks that facilitated check clearing and, in emergencies, could issue clearinghouse loan certificates. These certificates were a form of temporary money, backed by the collective assets of member banks. They allowed banks to settle obligations with each other without draining cash reserves. The New York Clearinghouse had issued such certificates during previous panics, and it did so again in 1907. The certificates helped ease some of the pressure, allowing banks to conserve cash for depositor withdrawals. But the certificates were not legal tender, and they did not address the public's desire for actual currency. People wanted dollar bills, not paper promises issued by bankers. Morgan also worked to convince banks to resume more normal lending operations. As long as banks hoarded cash, credit would remain frozen. But persuading bankers to lend required rebuilding their confidence that depositors would not drain reserves faster than loans could be repaid. This was a coordination problem. Each bank, acting in isolation, had an incentive to hoard. But if all banks hoarded, the collective outcome was worse for everyone. Morgan used his influence to broker agreements among major banks. He appealed to their self-interest, arguing that a prolonged credit freeze would damage their own portfolios and customer relationships. He also applied social pressure, leveraging his reputation and relationships. In one notable evening meeting at his library, he locked the doors and refused to let trust company presidents leave until they agreed to contribute to a joint rescue fund. The tactic was heavy-handed, but it worked. The president signed the agreement in the early hours of the morning. By mid-November, the worst of the panic had passed. Withdrawals at trust companies slowed and then reversed. Stock prices, though still depressed, stopped falling. The commercial paper market began to thaw. Currency flowed more freely. The crisis had lasted roughly 3 weeks, from the collapse of the Knickerbocker Trust on October 21st to the stabilization in early November. In that time, the financial system had come closer to complete breakdown than most people realized. The aftermath brought both relief and reflection. The economy entered a recession that lasted into 1908. Thousands of businesses failed. Unemployment rose sharply. The human cost of the panic was real and lasting. But the financial system itself had held. No major commercial banks had failed. The stock exchange had remained open. The clearinghouse mechanisms had functioned. And perhaps most importantly, a set of private actors had demonstrated the ability to coordinate a collective response in the absence of government intervention. Yet the crisis also exposed the fragility of a system that depended on the personal authority of a single individual. J.P. Morgan had played a central role, but he was 70 years old. What would happen in the next panic if he were not available? What if the next crisis exceeded the capacity of private coordination? These questions lingered. In the years following 1907, momentum built for financial reform. Lawmakers, economists, and bankers debated the structure of the monetary system. Some argued for a European-style central bank with strong government control. Others preferred a decentralized system that preserved regional autonomy and limited federal power. The debates were contentious, reflecting deep disagreements about the role of government, the risks of concentrated financial power, and the balance between stability and flexibility. The outcome of these debates was the Federal Reserve Act, signed into law in December 1913. The Federal Reserve System created a network of regional reserve banks, coordinated by a central board, with the authority to issue currency, set interest rates, and act as a lender of last resort. It was, in many ways, a response to the lessons of 1907. The goal was to institutionalize the kind of emergency coordination that Morgan had improvised, making it systematic rather than relying on the judgment and reputation of private individuals. But the creation of the Federal Reserve did not eliminate financial panics. The system would face severe tests in the decades that followed, including the banking crises of the Great Depression and the disruptions of more recent times. The 1907 panic demonstrated that financial stability is not a static condition but an ongoing challenge, requiring adaptation, coordination, and sometimes difficult decisions about which institutions to save and which to let fail. In the quieter months after the panic subsided, J.P. Morgan returned to a more routine existence, though his role in the crisis had cemented his place in financial history. He did not seek public acclaim. He gave few interviews and avoided detailed public explanations of his decisions. To Morgan, the actions taken in October and November 1907 were practical necessities, not heroic gestures. The system had been on the edge, and someone had to step forward. It happened to be him. Yet Morgan's role also sparked criticism. Progressive reformers and populist politicians pointed to the crisis as evidence that too much power was concentrated in too few hands. If one man could decide which institution survived and which failed, was that not a form of private tyranny? The fact that Morgan had helped orchestrate the U.S. steel acquisition of Tennessee Coal and Iron, expanding an already massive corporation, only intensified the criticism. Some accused him of using the crisis to advance his own interests, blurring the line between public service and private gain. Morgan's defenders argued that he had acted in the collective interest, that his interventions had prevented a far worse collapse, and that his financial rewards, if any, were secondary to the broader goal of stabilization. They noted that he had risked his own capital and reputation, that he had worked exhaustively during the crisis, and that no government entity had been willing or able to take the lead. The debate over his legacy reflected deeper tensions in American society about the role of wealth, the limits of private power, and the responsibilities of those who wielded it. These tensions were not unique to 1907. They had roots in earlier conflicts, including the debates over the Second Bank of the United States in the 1830s and the currency controversies of the late 19th century. They would continue into the 20th century, shaping financial regulation, antitrust policy, and the structure of governance. The Panic of 1907 became a reference point in these ongoing debates, cited by those who favored stronger government oversight and by those who defended private initiative. The mechanics of the panic also invited analysis. Economists and financial historians studied the sequence of events, trying to identify lessons and patterns. One observation was the speed with which confidence could erode. The Knickerbocker Trust had been considered secure until the moment it was not. The shift happened in days, not months. This highlighted the fragility of institutions that depended on trust, and the difficulty of distinguishing between temporary liquidity problems and genuine insolvency. Another lesson involved the interconnectedness of financial institutions. The failure of a single trust company triggered withdrawals at others. The distress in brokerage houses threatened banks. The city government's fiscal problems added to the overall strain. Modern observers might describe this as systemic risk, the idea that failures in one part of the financial system can propagate to others through channels that are not always visible until a crisis occurs. In 1907, these channels were primarily reputational and psychological, mediated through the decisions of depositors and investors, but they were no less real for being intangible. The role of information, or the lack of it, also stood out. Depositors often had limited knowledge about the true financial condition of the institutions they patronized. They relied on reputation, on the appearance of stability, and on the actions of others. When rumors spread, it was difficult to verify them quickly. Newspapers printed conflicting reports. Bank officials issued reassuring statements that were not always believed. In such an environment, fear could become self-fulfilling. A run on a solvent bank, if large enough and fast enough, could render the bank insolvent simply by forcing the liquidation of assets at distressed prices. This dynamic raised questions about transparency and disclosure. Should banks be required to publish more detailed information about their holdings and liabilities? Would greater transparency reduce panic, or would it simply provide more fodder for speculation and rumor? The answers were not obvious. Even today, with far more sophisticated regulatory frameworks and reporting requirements, the balance between transparency and stability remains a subject of debate. The Panic of 1907 also illustrated the limits of market discipline. In theory, depositors and investors who carefully assessed risk would allocate capital to the soundest institutions, rewarding prudence and punishing recklessness. In practice, during a panic, distinctions blurred. Strong institutions suffered alongside weak ones. Depositors withdrew from trust companies that had made conservative investments simply because they feared that others would withdraw first. This collective action problem meant that market discipline, while useful in normal times, could break down precisely when it was needed most. Morgan and his fellow bankers understood this intuitively. Their rescue efforts were not based on moral hazard concerns or market discipline theories. They were based on the practical recognition that a cascade of failures would harm everyone, including the institutions that had behaved prudently. The calculus was pragmatic: support the system to protect individual interests, even if that meant temporarily overriding market mechanisms. Years later, this approach would be formalized in the concept of a lender of last resort, a central authority with the ability and willingness to provide liquidity to solvent but illiquid institutions during a crisis. The Federal Reserve, once established, would take on this role. But in 1907, the lender of last resort was an informal consortium led by a private banker whose authority derived from reputation and relationships rather than legal mandate. The international dimension of the panic also merits attention. Financial markets in 1907 were globally interconnected, though not to the extent they would become in later decades. The panic in New York affected markets in London, Paris, and Berlin. European banks held American securities and had correspondent relationships with American institutions. When the panic hit, some European banks restricted credit to American borrowers, tightening the liquidity squeeze. Conversely, the Bank of England, acting in its traditional role as a stabilizing force, took steps to ease conditions, which indirectly helped calm American markets. This international dimension foreshadowed the global financial linkages that would define the 20th and 21st centuries. A crisis in one major financial center could no longer be contained within national borders. The flows of capital, the networks of credit, and the expectations of investors created a system in which stability required coordination across countries and continents. The panic of 1907 was an early example of this reality, a preview of challenges that would become more pronounced over time. In the decades following the panic, the American financial system evolved in ways that reflected the lessons of 1907. The Federal Reserve, as mentioned, was the most direct institutional response. But other changes occurred as well. Trust companies, which had been at the center of the crisis, faced increased regulation and oversight. Many merged with commercial banks or converted to bank charters, subject to stricter reserve requirements and examination. The era of freewheeling trust company expansion with minimal regulatory constraints came to an end. The stock market also saw reforms, though these took longer to implement. The panic had exposed the vulnerability of brokerage houses to liquidity shocks and the dangers of excessive leverage. In the 1930s, after another and far more severe crisis, the Securities and Exchange Commission would be established to regulate securities markets, require disclosure, and limit certain speculative practices. The groundwork for these reforms, however, was laid in the reflections and debates that followed 1907. Banking regulation more broadly shifted toward a model that emphasized stability over unfettered competition. The idea that banks should be allowed to fail, that market discipline alone could ensure soundness, gave way to a recognition that financial institutions had special characteristics that justified government oversight. Banks were not like other businesses. Their failures imposed costs on depositors, on borrowers, and on the economy as a whole. Preventing those failures, or at least managing them in an orderly way, became a public policy priority. Yet regulation brought its own challenges and trade-offs. Stricter rules could reduce risk, but also constrain innovation and credit availability. Deposit insurance, introduced in the 1930s, reduced the likelihood of bank runs, but potentially encouraged riskier behavior by banks, knowing that depositors were protected. The balance between safety and dynamism, between preventing crises and allowing the financial system to adapt and grow, would remain a persistent tension. The legacy of J.P. Morgan himself is complex. In the years after 1907, he continued to wield significant influence, but his power was increasingly questioned. The Pujo Committee hearings in 1912 investigated the concentration of financial power, calling Morgan to testify. He defended his actions and his role, but the hearings contributed to a shift in public sentiment. The era of the great financier, the individual banker who could shape markets and industries through personal authority, was drawing to a close. Institutional structures, regulatory frameworks, and collective mechanisms were beginning to replace the informal networks that Morgan had embodied. Morgan died in 1913, just months before the Federal Reserve Act was signed into law. He did not live to see the system he had helped stabilize transform into one with a formal lender of last resort. Whether he would have approved of the Federal Reserve is a matter of speculation. He had always been skeptical of government intervention in financial markets, preferring private coordination. But he also understood the fragility of the system and the limits of private action. Perhaps he would have seen the Federal Reserve as a necessary evolution, a way to institutionalize the kind of emergency response that he had improvised in 1907. The broader question raised by the Panic of 1907 is about the nature of financial stability itself. Stability is not the absence of risk. It is the capacity to absorb shocks, to adapt to changing conditions, and to maintain confidence even when uncertainty is high. Achieving stability requires a combination of sound institutions, effective regulation, and, at critical moments, decisive action. It also requires a collective understanding that individual self-interest, while important, must sometimes be balanced against systemic considerations. The Panic of 1907 was resolved not because every institution acted rationally in its own interest, but because key actors recognized that their interests were interdependent. Morgan's leadership mattered, but so did the willingness of other bankers to contribute to joint rescues, to extend credit when it was risky to do so, and to accept temporary losses for the sake of longer-term stability. This kind of coordination is difficult to engineer and impossible to mandate. It depends on trust, on relationships, and on a shared sense of what is at stake. In modern times, financial crises continue to occur. The mechanisms differ, the institutions involved have changed, and the regulatory environment is far more developed. But the underlying dynamics often echo 1907, a loss of confidence, a scramble for liquidity, the contagion of fear, and the need for coordinated action to restore stability. The tools available today, from central bank interventions to deposit insurance to stress tests and capital requirements, are more sophisticated, but the fundamental challenge remains: how to maintain trust in a system that depends on belief, and how to act quickly and decisively when that belief falters. The Panic of 1907 reminds us that financial systems are not mechanical. They are social constructs, shaped by human behavior, by expectations, and by the stories we tell about risk and value. Markets are efficient in many respects, but they are also vulnerable to panic, to herd behavior, and to self-fulfilling prophecies. Recognizing this duality and building institutions that can navigate it is an ongoing project, one that draws lessons from history while adapting to new circumstances. Looking back at that autumn of 1907, it is striking how much was at stake and how narrowly disaster was avoided. The United States did not have a central bank. The safety nets that we take for granted today did not exist, yet the system held in large part because a small group of individuals chose to act collectively, to take risks, and to put the stability of the system above immediate self-interest. Their actions were not perfect, and the choices they made were not without controversy. But they navigated a moment of profound uncertainty and prevented a collapse that could have been far worse. The story of J.P. Morgan and the Panic of 1907 is not a simple morality tale. It does not offer easy lessons about heroes and villains, about the virtues of free markets or the necessity of regulation. It is a story about complexity, about interdependence, and about the fragile nature of confidence. It is a reminder that financial systems are built on trust, and that trust, once lost, is difficult to rebuild. It is also a reminder that institutions matter, that leadership matters, and that in moments of crisis, the willingness to act, even imperfectly, can make the difference between order and chaos. As the weeks turned into months and 1907 gave way to 1908, the scars of the panic remained visible. Businesses that had failed did not return. Workers who had lost jobs struggled to find employment. The recession that followed the panic was real and painful, a reminder that financial crises have consequences that extend far beyond the walls of banks and brokerage houses. The economy, which had been growing robustly before the panic, contracted sharply. It would take time for confidence to fully return, for credit to flow normally again, for the wheels of commerce to regain their momentum. Yet there was also resilience. The financial system, though shaken, had not shattered. The institutions that survived emerged with a clearer understanding of their vulnerabilities and, in many cases, a greater appreciation for the need to maintain stronger reserves and more conservative lending practices. The regulatory conversations that followed the panic laid the groundwork for a more stable architecture, one that would take years to fully construct, but that represented a shift in how Americans thought about the relationship between finance and governance. The human element of the panic is worth pausing on. Behind the statistics, the dollar figures, the names of banks and trust companies, were millions of individuals whose lives were touched by the crisis. There were depositors who stood in line for hours, uncertain whether they would recover their savings. There were clerks and tellers who worked exhausting shifts, counting cash and processing withdrawals, trying to maintain composure in the face of fear. There were families who tightened their budgets, who delayed purchases, who worried about the future. And there were the bankers and financiers who made difficult decisions, who risked their reputations and their capital, who stayed up late in dimly lit offices trying to solve problems that had no clear solutions. Morgan himself, in the years after the panic, rarely spoke publicly about his role. He gave no speeches claiming credit, wrote no memoirs detailing his decisions. To those who asked, he described his actions as simply what needed to be done. There was no grand philosophy, no elaborate theory. The system was failing, and someone had to act. The simplicity of that explanation belies the complexity of the decisions he faced, the pressures he navigated, and the consequences, both intended and unintended, that followed. In the quiet that eventually returned to Wall Street, there was a sense of having survived something significant, a moment when the foundations of the financial world had trembled and then, somehow, held. The panic of 1907 became part of the collective memory, a reference point for future crises, a case study in how quickly things can unravel and how much depends on the decisions made in those critical hours and days. Time moves forward, and financial systems evolve. The world of 1907, with its horse-drawn carriages and telegraph wires, its limited regulatory apparatus and its reliance on personal relationships, is distant from the world of today. Yet the core challenges persist. How do we build systems that are resilient without being rigid? How do we maintain confidence without encouraging recklessness? How do we balance the need for stability with the benefits of dynamism and innovation? These questions do not have final answers. They must be revisited, reconsidered, and renegotiated with each new generation and each new crisis. The panic of 1907 offers no simple prescriptions. It does not tell us exactly what to do the next time markets falter or trust evaporates. But it does offer perspective. It reminds us that financial stability is not a given, that it must be actively maintained, and that in moments of crisis, the choices we make matter. It reminds us that coordination is possible, even in the absence of formal authority when the stakes are high and the collective will is present. And it reminds us that history, while never repeating exactly, often echoes, and that understanding the past can help us navigate the uncertainties of the future. As we drift toward the close of this story, the images linger. The lines outside the Knickerbocker Trust, The late-night meetings in Morgan's library, the armored wagons delivering cash through the streets of New York, the stock exchange floor where fortunes were made and lost in a single session. These are the moments that define an era, the turning points when the course of history shifts, often imperceptibly at first, and then with undeniable force. The autumn of 1907 was one such turning point. It marked the end of an era of unregulated finance and the beginning of a gradual, contested, and ongoing effort to build a more stable system. It showcased both the strengths and weaknesses of relying on private coordination in the face of systemic crisis. And it left a legacy that continues to shape how we think about banks, about central banks, about regulation, and about the delicate balance between freedom and stability in financial markets. Tonight, as we let the story settle, we can appreciate the distance traveled and the lessons, however imperfect, that the panic of 1907 has left behind. The voices from that autumn, the decisions made in those tense days, the risks taken and the consequences faced, all form part of a larger narrative about how societies manage uncertainty, how they respond to fear, and how sometimes they find a way through the darkness. Rest now. The story has been told, the panic has passed, and in the quiet of this moment there is only the gentle pull of sleep, the slow exhale of a long day, and the knowledge that history, with all its complexity and its lessons, continues to unfold.